Welcome to the Phronesis Partners podcast, Navigate with Confidence. In each episode, we sit down with our clients and other thought leaders to discuss how they and their own customers use insights and data to illuminate, validate, and navigate their paths to growth and competitive success. We welcome you to join us as we uncover and explore the unknown so that business leaders like you can navigate your own opportunities and challenges with speed, accuracy, and confidence.
Hello, I'm Katharine Rooney, Editorial Director at Phronesis Partners. In our last episode, our CMO Elaine Pratt spoke with Maureen Oluwole, Chair of the Luxury Innovation Summit, about the evolution of the luxury sector. Today, I'm joined by Stephen Morgan, Managing Director of our Lifestyle and Media Advisory practice, who attended the summit this week. Stephen chaired a panel looking at the future of luxury investment. He engaged with leading investors, advisors, and founders to explore where capital is flowing across the luxury innovation ecosystem and examine where the risks and opportunities lie. Stephen, thank you for joining me today. Let's start with a bit of a temperature check. We know that the luxury sector has been facing some headwinds recently. How would you describe the overall mood at the summit? Were there concerns for the future of luxury, or are there still reasons for optimism?
Thanks, Catherine. So I would say cautious optimism was the general sense. I think that lots of conversations around markets like the Middle East and India, where there are growth opportunities, particularly again in the watches and hard luxury space. Signs of growth in China, and a belief, all things being equal, and that's a heavy caveat. All things being equal, sort of returning consumer confidence in the US, and that all things being equal is clearly very much affected by the overall kind of geopolitical situation. So yeah, cautious optimism is what I would say is what I experienced in Geneva this week.
Okay, great. And looking at different regions globally, where is there likely to be the most growth, and where are luxury brands struggling?
I would say that signs of growth in China. US, no one's quite sure, but there's a belief that consumer confidence will return, all things being equal, geopolitically. And then Europe is probably where brands are struggling, and that could be a direct result of kind of very strong price increases. An industry that's probably overly heavily relied on price increases in the last 10 years.
And just as a follow-on to that, why do you think that customers, clients of luxury brands are now starting to push back and resist those price rises?
So I think a statistic that was quoted at the conference was we'd seen 80% price increases across many categories over the last 10 years. So the industry's moved from price being one of the marketing levers for these brands to being the only marketing lever. So as a result of that, in luxury consumers' eyes, the whole price value equation is in danger of breaking.
Okay, thank you. One of the other things that we've recently done some work for EY with their luxury client index, and we saw a growing appetite for pre-owned items, especially certified pre-owned. Is that part of a broader trend in luxury, would you say?
Yeah, very much so. All the data, and I read that report too, all the data points to kind of pre-owned, if you like, certainly growing at a much faster rate than new. And I think that there's a number of interesting things around that. Firstly, anecdotally, August, many of the resale platforms had record months. In fact, over 30% in terms of transactions. And it's interesting to unpick why that's the case. I think there's an element of recent kind of multi-brand retailers going bankrupt. There's an element of kind of tariffs around the supply side. But it's yes, resale. To answer your question, resale is very evidently, along with those growth markets of the Middle East and India, resale is part of the optimism in the industry.
Is that something that you discussed at the summit itself? Perhaps some of the reasons behind that was sustainability, drivers, maybe another reason for people investing in secondhand?
Yes, sustainability. I think for younger consumers, their first experience with luxury goods is or luxury brands is often through resale. On my panel, we had Stephanie Crespin, CEO and founder of Reflaunt, which is a resale enabler for luxury brands, and she was able to speak to it was actually Stephanie who shared that volumes were up 30% in August. But no, there's a far greater desire now from brands to engage with resale. I think in some instances, some brands were early adopters, but many other brands viewed resale through a kind of rather suspicious lens. But now what we are seeing is brands are realizing they've got to engage with resale.
Speaking of sustainability, what are some of the risks around that from an investment perspective? What might influence investment within luxury brands with regard to sustainability? I believe you mentioned at the summit, you talked about brands investing in their own manufacturing facilities, for instance, and looking to own the supply chain more.
Yes, if you go back to the EY luxury client index that you referred to earlier, one of the data points was around how consumers hate greenwashing and hate to think they're being greenwashed. And I suppose one of the talking points in my panel was around this area around brands claiming to be sustainable or to be much more transparent. And that's actually very difficult if a brand doesn't own its own supply chain or manufacturing capability. How could you make claims around the veracity of the of your sustainability claims if you don't actually own the manufacturing and the supply chain? So what we are seeing from an investment point of view, to answer your question, is we are seeing brands increasingly beginning to vertically integrate. So maybe what isn't so publicly available is the amount of transactions that are happening with brands actually buying mills, artisan manufacturers, factories, just to be able to get hold of this whole sustainability issue.
As well as from a reputational perspective, what impact does that have on the bottom line? Is that making brands more attractive to investors?
Yes, I think that, well, firstly, I think it makes it more attractive to consumers, because when a brand then says that actually, we are sustainable, or we're B Corp, and then all these other various accreditations, if they actually are truly vertically integrated, you can believe them a lot more. From an investment point of view, I would say yes. I think that if you look at supply chain shocks, and I suppose tariffs would be a supply chain shock, your ability to ride out those shocks if you're fully in control of your manufacturing and supply chain is that much stronger than if you were simply a brand relying on a host of third-party partners.
Can you give examples, for instance, of where this is happening, owning the supply chain, instances of where that might have affected acquisitions or investments?
Yeah, so I think that this builds on something we used to talk about at Vogue Business quite a lot, actually, which is we used to run a series of events around sustainability in the fashion industry, which is sustainability is too big a thing just to invite brands to sort of engage with and discuss, because actually brands on their own can't actually affect that much change. The real people if you like, players in the industry who can affect change around sustainability are the manufacturers themselves. And so often manufacturers are excluded from these conversations and initiatives. But so going back to your question, I think what you are seeing is increasingly brands beginning to want to vertically integrate, to be able to begin to own manufacturing capabilities, for example, that maybe a few years ago they shared or they decided not to own. Most of these brands, of course, started out fully vertically integrated 50, 100 years ago, that then became steadily less vertically integrated, but are now returning to vertical integration to be in a position to make sustainable claims about their supply chain, but also to ride out supply chain shocks. And obviously we've seen a few of those of late.
Does that have any impact on pricing as well? The fact that they are owning more of the chain themselves, is it sort of lessen, the middleman kind of price rises that we might see otherwise?
I'm not sure about pricing, but I think it should lead to efficiency. You would imagine a vertically integrated business is in a far better place um, to match supply with demand. Whereas clearly, if you're a brand relying on a host of third-party partnerships, that's just harder to do. So I think it's efficiency, which I guess could lead ultimately to a reset in pricing. But I think I'd probably look at efficiency rather than pricing.
And are there any examples you can share of where investment has taken place as a result of that integration, that increase in supply chain ownership?
So I think that, when we talked about investment, so while I think that if you look at M&A at a brand level, certainly in the last year, it's very slow. It's quiet, you would say. In fact, what transactions are happening tend to be privatizations, and I think we talked about the Todd's privatization on my panel, which El Catterton advised on. But where there are transactions happening, which are kind of away from the public eye, are brands investing in, again, possibly manufacturing capability, supply chain capability that maybe we wouldn't really know, but certainly it could be mills in Italy, or it could be manufacturing in Southeast Asia. That's where brands are spending their money now, as opposed to having a shopping list of other brands that they're choosing to buy.
And how are outside investors responding to that activity? Private investment, for instance.
Yeah, I think what's interesting about it, it's a new way of investing in the industry. I think the old way of investing in the industry was, institutions acquiring brands. I think there is a new way of investing in the industry, which is actually acquiring manufacturing capability. So I suppose it's a slight shift. It's a potential shift in the way someone might wish to invest in the luxury industry. It doesn't have to be at the brand level.
So I think, like every other industry, luxury operations are being impacted by AI. What are the positives and negatives of this from an investment perspective?
So as you might expect, over 2 days, I think every panel talked about AI. And again, I think in that luxury client index that we referred to earlier, Rachel from EY Farber Nobel talked about 3 applications of AI, which actually largely came out of that index. But from an investment perspective, I thought there was 2 things that I thought were interesting from Luigi at El Catterton. Firstly, they look at a brand's management team and their knowledge and awareness of AI as an indication of whether they want to invest in that leadership team. It clearly a leadership team that, if you like, seems very behind the ball when it comes to AI is not a leadership team that they would invest in. I thought that was kind of interesting. And the second thing I thought was interesting was an example he gave of he couldn't mention the client, but for 6 months they ran a potential process around obviously investing in I think it was a marketplace actually, and they ended up at the 11th hour pulling back simply because there was a concern that kind of what is the impact of AI going to be on this on this potential investment that we make. So I thought what was interesting about AI with those 2 examples were that in what is anyway still a relatively tough investment climate, although there is cautious optimism right now. It is kind of a tough investment climate. The impact of AI is either potentially slowing investment decisions or even putting investments off. Just I thought that was an interesting observation.
Why is it so important, do you think, for leadership of these brands to be familiar with the way AI operates, the way it might be
Well, I think it's
impacting their
yeah,
business?
I think it's less about AI itself, but it's more an indicator of the agility and depth of a leadership team. I suppose that was the interesting thing. AI is almost a proxy for understanding the qualities of a leadership team.
You spoke a few moments ago about Todd's and the privatization of that brand. seen a number of luxury brands in the past few years going private in an effort to reset their value propositions. Is this something we're more likely to see in the current economic climate, do you think?
Yes, I mean, I think we talked about on the panel about the general trend, and I think the 7-year trend has gone from, if you take PE for example, a series of minority investments probably 6-7 years ago that moved into then actually some majority investments. L. Catterton's investment in Birkenstock would be one of those, for example. Then we saw a period of consolidations and the beginnings of what you're seeing with privatization. I think to exactly your point, which is basically, I think luxury brands needing to take themselves out of the firing line of having to report on quarterly earnings. And now I think what you're seeing is I go back to that cautious optimism quote. I think I think there is some kind of IPO planning going ahead. I think that a number of IPOs, there was a number of investments where I think investors wished to exit probably a year, 2 years ago that clearly didn't happen because where the markets were. But I think as the markets kind of start to react a bit better, we might see a spate of IPOs happening.
Looking ahead to the next couple of years then, what would you say the overall outlook is for luxury investment, for luxury brands? Is there a particular direction of travel, do you think? Are there areas that you think we may be seeing more acquisitions, more different types of luxury businesses that investors are most interested in?
I think two things. I think firstly, big caveat in everything we spoke about was what's happening geopolitically. I think that there was, across not just my panel, but what's happening, but across all the other panels, the big caveat to what everyone spoke about was, let's just see kind of what happens with wars, conflict, and supply chain shocks. But if we assume, if we take a positive sense, we take a positive outlook that those sort of calm down or at least become manageable. I think that resale will only get stronger, and I think we might see new market entrants, new models in resale. One of the interesting things on my panel, which I thought was interesting, was around celebrity actually, and beauty. And I think what's interesting, we talked about a recent transaction in the beauty industry, which was the Elf acquisition of Rhode, which is almost ridiculously a brand valued at over €1 billion that had only been going sort of 4 years. But it's the power of celebrity in that particular instance, and we might see more of those type of transactions actually feed through into luxury, which historically has been less kind of celebrity led.
You mentioned also actually some leadership coming from the beauty industry more into luxury fashion, perhaps, because obviously one of the other things that's happened in the last few months is there have been a number of new creative directors coming into luxury brands. But when we spoke about this the other day, you were saying that actually it's the CMOs who are really making a difference to the appeal of a brand. Could you speak about that a little bit more?
Yes, I think so. I think luxury is slightly guilty of being a little bit insular. I think most people at the conference would have agreed that. It's quite an insular industry, and I think what we're seeing now is people from outside luxury coming in positions of leadership. So, I guess a common thread in some of the conversations was around CMOs. Actually, it's interesting how CMOs are coming into luxury fashion, luxury or hard luxury from outside the industry, and whether that's the CMO or even the CEO. What's interesting is the new CEO at Kering coming from Renault, which would almost be unthinkable a few years ago. And a number of CMOs, particularly again, I go back to the beauty industry or the CPG industry, now find themselves in very senior positions at luxury brands. So I think that's a kind of an interesting and a fairly positive phenomena in the luxury industry right now.
What do you think is driving that change, that new acceptance of people from outside the traditional industry sources?
I think it's an acceptance that actually brands need to be more insights led. They need to understand customers. Whereas I think traditionally old luxury had more of a build it and they'll come mentality. I think that brands are beginning to realize they need to move to their customers. And I think industries that are better at understanding customers and building products around customer needs tend to be in industries like beauty and CPG.
Just wrapping up, Stephen, this is, luxury, luxury media, luxury products is very much your area of expertise. What are you most excited about within the sector in the next 5 years or so?
I think India is interesting because I feel that for as long as I've been doing this, India's been called out as a coming market, and it hasn't quite happened. So I'll be really interested, at this particular point where we are, whether that actually kind of happens. Structurally, I think it's really going to be really interesting around the future of multi-brand retail, which for a long time has been an important part of the industry, but that that doesn't. Every week that goes by, there appears to be another multi-brand retailer either bankrupt or flirting with bankruptcy. So distribution side's going to be fascinating to watch, and tech. And I think that one of the other things I thought was interesting from the conference was obviously people talk about technology in the back end, but putting technology in the hands of, for example, sales associates at the front end. How can we use technology to improve the retail experience, whether that's in store or digitally? So I think those would be some of the things I'm curious about.
It'll certainly be fascinating to watch that all evolve in the next few years. Thank you, Stephen, for those insights, and thanks for listening to Navigate with Confidence. I'm Katharine Rooney, and we'll see you next time.
If you enjoyed this episode, please subscribe to the podcast and don't forget to follow us on social media for the latest updates and behind-the-scenes content. Stay tuned for more episodes where we will continue to explore and navigate the complex world of B2B sales and more to provide you with the insights you need to navigate your business decisions with confidence.